Have you been working your ass off, saving as much money as you can, taking on extra shifts or even a second job just to save a deposit for your dream home or an investment property? Then my guess is that despite your best efforts and all the hard work that you have put into saving for a deposit, the dream of home ownership seems more and more out of reach because of the crazy growth that we are seeing in our property markets. This is happening to millions of Australians who are trying to get into the property market or get their next investment property. With the property market going absolutely crazy and house prices growing at 10 times the rate of wages in Australia, a lot of people are becoming very frustrated by the whole situation. Saving a deposit for a $500,000 or $1 million house in the current environment is just very hard to do because the cost of living is rising so rapidly. But there are solutions to help you overcome this hurdle. And that's exactly what we are going to talk about in today's video. Hey guys, welcome back to the channel. My name is Zeng and I have built a multi-million dollar property portfolio by the age of 28. And now I make weekly videos on the topics of personal finance, real estate, and property investing. So if that's something you're interested in, make sure to subscribe to the channel for more awesome content. I'm about to share with you the top tips to help you fast track your property investing journey and some of the different tricks that I used to help me build my multi-million dollar property portfolio. But please understand that none of this is financial advice and I am not a financial advisor. I am simply sharing with you my personal opinions and strategies, and I will always recommend you to speak to a real financial expert before doing anything crazy. Let's start by talking about a deposit for a house. 20% is what most banks and financial planners will recommend because it shows the bank that you are a good saver and you have the right money habits to take on a mortgage. And it also gives you a safety cushion for when things don't go according to plan. However, we are in a very different world now compared to 20 years ago. And saving a 20% deposit can be very daunting and sometimes impossible with house prices being so expensive already, and it is still growing at such a rapid rate that it is almost hard to keep up. While people are working hard and saving their asses off just to get a deposit together, house prices are also growing at a very rapid rate, meaning a $400,000 house could be $500,000 in 2 years' time. Meaning the deposit required will also go from $80,000 to $100,000. But what if I told you there were ways around this and that you could get into a property a lot sooner than you originally thought? Lender's mortgage insurance, also known as LMI, is insurance that protects the lender, and it is usually a once-off payment paid by the buyer at the time of settlement. Lender's mortgage insurance is a very powerful tool for those who are struggling to save a 20% deposit. For example, if you wanted to purchase a $500,000 house and you didn't have the $100,000 required as a 20% deposit, you could simply pay LMI and you could get into the same property with only a $50,000 deposit. The best part about this strategy is that you don't have to pay the LMI upfront. You can simply add it to your mortgage and you can pay it off over the next 30 years. For our previous example, if we enter the numbers into this LMI estimator, we can see that we will only be paying $8,600 in LMI over the next 30 years if we decide to put down a 10% deposit. For most people, saving an additional $50,000 could take a very long time. It could take 2, 3, 4, or 5 years. And by then, house prices could have gone up even more, meaning you will need an even bigger deposit. So it is very easy to understand why a lot of Australians have decided to just take advantage of LMI and get into the property market with only a 5, 10 or 15% deposit. It is pretty much a shortcut into home ownership. However, with all shortcuts, it comes with risks and additional costs. And that's something that not a lot of people talk about. You guys know that I am very transparent with you guys and I want you guys to make the most informed decisions by giving you all the information. And that's why it is very important for us to talk about both the pros and the cons. The first risk associated with using LMI is your equity position. For example, if the market was to take a sudden turn and retract by 20%, which has happened before, like what we saw in Melbourne and Sydney from 2017 to 2019, and like what we saw in Perth over the last 15 years. This 20% decline will put you into negative equity, which simply means the value of your loan is now higher than the value of your house. Now, if we fall into negative equity, the logical thing to do here is to hold that property and wait for the market to recover. However, a lot of inexperienced investors and first home buyers do not have the mindset or the mental preparedness. And this can lead to the first home buyers or the inexperienced investors panic selling their properties because they think the market is going to go down further, which will wipe out their entire deposit. And the worst part about that is that they will still own the bank money afterwards. Obviously, this is a very extreme scenario, but I can tell you that it does happen. But I want you to understand that and have the mental preparedness for it if you are thinking about using LMI. Another thing to consider is that when you put down a smaller deposit, the bank will see your mortgage as more risky, which will in turn attract higher interest rates and higher repayments. The interest rate on these smaller deposit loans will not be significantly higher, but it will compound over time and cost you quite a lot of money in interest repayments. Another issue with low deposit loans is that they are constantly under review by the policymakers, which means that if policies change in the future, or if the banks decide to reduce their risk appetite, we could see even higher interest rates for low deposit loans. And if you needed to refinance your property, it could be hard for you to secure finance if your LVR position is too high. To be completely honest, these scenarios probably won't play out, but I just want you guys to know that this can happen so that you are prepared for it if it does happen. Let's now move on and talk about interest-only loans. This is another very popular tool used by investors who are trying to build up a large property portfolio. And this is a tool that I also use from time to time. When we take up a mortgage, we have two options. The first option is principal and interest, and the second option is interest only. It ultimately comes down to whether we want to pay down our debt or not. Again, there are pros and there are cons for each strategy. So let's start with the pros for interest-only loans. When you have interest-only repayment, your repayments will be significantly lower. This is great because you get to keep more money in your pocket and can use that money for your next deposit. A lot of investors think interest-only loans are great because even though your debt is not getting any smaller, your debt is not immune to inflation. For example, a $500,000 loan might sound like a huge amount right now, but in 30 years' time, because of inflation, we won't think of that $500,000 as a huge amount. Another example that we can use is that back in 1990, around 30 years ago, the average house in Melbourne cost only $130,000, meaning the mortgage on that property will be around $100,000. For back then, that was definitely a lot of money. But fast forward to now, it is not that much money at all, and a couple on a decent income can pay that off in a year or two. This is what people mean when they say, let your debt be eroded away by inflation. So the assumption here is that your property will keep growing in value over the next 30 years, and your debt will remain the same, so that if you do sell your property in 30 years' time, you could easily pay off this debt that you have and still have a huge profit left over. This sounds pretty damn good, doesn't it? Well, again, this also comes with additional risk and additional costs. One of the main risks that we have is that because we are not paying down our debt in the current record low interest environment that we find ourselves in, over the next 10 to 20 years, we should expect to see much higher interest rates, meaning your repayments will increase significantly. And because you haven't been paying down your debt, you are fully exposed to these higher interest rates. But on the other hand, if we went with principal plus interest repayments, we'll be taking full advantage of the record low interest rates that we're currently in, and we'll be paying down our debt, so that when interest rates do rise, our loan amounts will be much smaller. Another thing to understand is that interest-only loans are constantly under review by the policymakers, and they are seen as more risky by the banks, meaning that it will attract a higher interest rate. We have already seen what happened back in 2017 when APRA stepped in and cracked down on interest-only loans. Even though those tough lending practices have since been eased, there are no promises that APRA will step back in and crack down on them again. Especially with our property markets growing at such a rapid rate, which will only further encourage the government to intervene. The federal election is also coming up, and the unaffordable nature of the housing market will be a very hot topic, meaning that we could definitely see some changes going forward. The third and final trick that we can use to grow our property portfolio faster is refinancing. Refinancing is, in my personal opinion, one of the greatest tools that an investor can use for a number of reasons. First of all, refinancing usually comes with very generous cashback offers. For example, the Bank of Melbourne and St. George Bank both offer $3,000 cashback if you refinance with them. That's money you could use to pay down your mortgage. Refinancing will also allow you to build your property portfolio much faster because it allows you to refinance and release equity, and then you can use that equity to purchase another property. This is provided that you have enough equity in your existing property and that your LVR position is not too high. For example, if you buy a property for $300,000 and you put down a 20% deposit, and after 5 years, that property is now worth $500,000 because you have already put down a 20% deposit. The loan amount on that property will be $240,000, which means you now have $260,000 worth for equity in that property. Most banks are comfortable to lend you 80% of the value of a property, meaning that they can lend you up to $400,000 for your $500,000 property. And since your loan amount is only $240,000, you can now borrow an additional $160,000, which you can then use as the deposit for another two $300,000 investment properties. This is provided that your borrowing capacity allows it. I hope that made sense. If it didn't, or if you have any questions, feel free to shoot me a message on my Instagram at @InvestWithZeng. Obviously, there are risks associated with every strategy, but with great risk comes great reward. I'm not a financial advisor, so I can't tell you what to do, but I can definitely show you how I've set up my personal portfolio and why I set up that way. I currently have 10 investment properties. 8 of those are on principal and interest repayments, and 2 of them are on interest-only repayments. And I have never used lender's mortgage insurance for any of my purchases. As you can probably tell, I take on quite a bit of calculated risk, and I don't mind that. But my risk tolerance is definitely lower than some others out there. Keeping most of my portfolio on principal and interest repayments will mean I'll get a lower interest rate, which will compound over time, especially when you have a big portfolio like I do. Because the repayments for my entire portfolio is so high every single month that any small saving will compound into huge savings over the life of my loans. And because I have so much debt under my belt, I really want to take advantage of this record low interest environment and pay down as much of that debt as I can, so that when the interest rate go back up to the long-term average of 5 or 6%, I won't be as concerned about my higher repayments because my loan amount will be much smaller. When times are great, like what we are seeing now with record low interest rates and house prices going through the roof, people love taking on debt, and they love taking on debt using interest-only loans. However, there will come a time where interest rates will be much higher and we won't see as much growth in our property market because we already know that when interest rates rise, our growth will slow down. By paying down my debt and reducing my repayments, I'm not only improving my cash flow position every single month, I'm also reducing my risk. Another important thing to understand is that the principal you pay on your loan is not dead money, because that goes towards the equity in your property, and you can always refinance that property to pull that equity out. And this sums up my conservative approach towards property investing. I really hope you guys enjoyed the video. If you did, please do me a huge favor by hitting that like button right there and subscribing to the channel. It will really help out the channel a ton. Stay safe out there, and I'll see all of you guys in the next video.